Today's headlines read like a trader's roller coaster Nvidia throwing $500 million at self-driving cars in London, Trump picking up the phone for a high-stakes chat with Xi Jinping, and Ray Dalio reminding us that gold might outshine your favorite tech stock when Uncle Sam's debt bill comes due.
It really does feel like that, doesn't it? More than just a roller coaster, maybe. It's like a structural tension point. You've got this incredible speed of private tech money.
Right.
And then you have the friction, a real drag of high-stakes geopolitics and trade.
On tariffs.
And tariffs, exactly.
Yeah.
And underneath it all, this kind of slow, grinding reality of macro financial instability. They're all moving at once, and the market is trying to figure out how they collide.
And that collision, that intersection is what matters. So for you, the listener, understanding how these seemingly separate things connect is absolutely crucial right now. We're going to do a deep exploration of these three critical global market drivers.
Yep.
The aim is to give you a quick but thorough understanding of what's really driving the volatility today. And maybe, just maybe, what's shaping the longer-term changes coming tomorrow.
And we've pulled together quite a stack of sources here. We're looking across three sort of distinct arenas.
Yeah.
First, the future of AI mobility, specifically focusing on Nvidia's huge capital move in the UK.
Okay.
Second, that really complex regulatory and trade dance between the US and China. We'll dig into the tariffs, obviously, and the whole TikTok situation.
Which never seems to go away.
It really doesn't. And finally, we'll look at that high-level commentary, the big picture stuff, on global fiscal sustainability, mostly driven by, frankly, the alarming scale of U.S. debt.
That is definitely a lot to unpack. Let's start with the sheer speed of money. That Nvidia commitment across the pond, it's pretty eye-watering.
It is.
We're talking about one of the world's most powerful tech companies signing a letter of intent, right? Not a done deal yet, but a strong intention.
A very strong intention.
For a possible $500 million investment. $500 million into the next funding round for Wayve. That's a UK self-driving startup.
$500 million is a massive signal. And, it's not like this came out of nowhere. This isn't Nvidia just picking a name out of a hat.
Right, they've been involved before.
Yeah, this investment actually builds on an already pretty solid ecosystem around Wayve. The company was already supported by Nvidia in previous rounds. Remember, Wayve raised over $1 billion just last year.
$1 billion? Wow.
Yeah, in a round led by SoftBank Group. And on top of that, Uber also made a separate undisclosed investment earlier this year in 2024. So Wayve has some serious backers already.
Okay, so this isn't just a new fling. It's Nvidia really doubling down on something they already see potential in. A proven, maybe not fully scaled yet, but a technology they like.
Exactly. Doubling down is the right way to put it.
But, self-driving, it feels like a crowded field. Lots of companies, lots of hype, lots of money spent. What's the aha moment with Wayve? What makes their tech stand out enough for Nvidia to make this kind of bet, especially when other big AV names have, struggled to really scale up?
That's the key question, isn't it? And this is where we need to shift from just looking at the dollar signs to understanding the core technology difference.
Okay.
So conventional self-driving systems, the ones that kind of dominated the early race, they rely really heavily on what you might call a rule-based approach.
Rule-based, meaning?
Meaning they use incredibly detailed, high-definition digital maps. Often these are created using expensive LiDAR sensors, the spinning things you see on top of the cars.
Oh, yeah.
And then they rely on engineers writing tons and tons of specific code for almost every imaginable scenario. Like, turn here, stop for that specific traffic light, avoid that known pothole.
Which sounds incredibly rigid. And I guess means if they want to operate in a new city, they basically have to start from scratch. Remap everything, recode for all the local quirks. That must be hugely time-consuming.
Exactly. Immensely time-consuming and very, very expensive. That's been a major bottleneck for scaling. Wayve's approach, the thing that differentiates them, is what you could call pure AI-centric mobility.
AI-centric.
They use machine learning primarily with standard, much less expensive camera sensors. So think more like the cameras already in many modern cars, combined with sophisticated AI.
So less reliance on LiDAR and those hyper-detailed maps.
Much less. Instead of trying to pre-program the car for every single rule of the road and every inch of the map, they focus on teaching the AI system to learn directly from observing raw, real-world traffic patterns and, crucially, actual human driver behavior.
Ah, so it learns by watching.
In a sense, yes. Instead of trying to code the entire world, which, let's face it, is probably an impossible task given the chaos of real driving.
Yeah.
You're teaching the system to observe, to predict what other road users might do, and then react appropriately. The system learns the context of driving, not just a fixed set of pre-written rules.
So, okay, let me see if I get this. If they can teach the AI how to handle, say, the complex roundabouts and busy streets of London,
Right?
then theoretically that learned knowledge, that driving intelligence, could be applied much more quickly to Tokyo or New York or anywhere else, maybe with just some minor adjustments for local rules, like driving on the other side of the road.
That's the core idea. The potential for faster, more efficient global scalability is, I think, the big appeal here. You're not rebuilding the foundational intelligence for each new location.
Okay, that makes sense. It's a bet on a more scalable approach to autonomy and securing a key player in that race. Yeah, I can see why Nvidia would be interested.
And that strategic angle is really key to understanding NVIDIA's bigger picture here. This isn't just about selling more GPUs for data centers, although that's still huge for them, obviously.
Yeah.
This kind of investment, it signals their commitment to controlling, or at least being a major player in, the entire AI-powered mobility ecosystem. They're moving beyond just supplying the raw computing power.
So being embedded in the systems that actually use that power to disrupt massive industries like transportation.
Precisely. Becoming a vested partner, shaping the direction of the technology itself.
Now, you mentioned this sits within a larger context, right? Geopolitics starts to creep in here, too.
It really does. This specific Wayve investment came alongside, or at least as part of, NVIDIA's much bigger overarching pledge. They committed £2 billion. That's about, what, 2.70 billion US dollars?
£2 billion. Wow.
Yeah, £2 billion in total investments directed specifically at the British AI startup ecosystem. This isn't just one company. It's a strategic commitment to an entire geographic tech hub.
Okay, so that's NVIDIA planting a very large flag in the UK AI scene, essentially trying to cement their dominance in the Western AI sphere.
You could certainly see it that way. And it's interesting timing, too. We know this investment follows pretty closely after the UK and the United States signed a new technology pact.
Ah, right. I remember reading about that. Aimed specifically at boosting ties in AI research and development, wasn't it?
Exactly. So when Nvidia, a U.S. tech giant, makes this kind of significant financial commitment to a leading UK AI player like Wayve, it definitely reinforces that political and technological alignment between the two nations, especially, in the context of global competition in AI, particularly with China.
So for you, the listener, tracking Wayve's progress could be a useful indicator then of market momentum in this specific AI application.
I think so, yes. The sources confirm they're currently operating in Britain and the U.S., which makes sense. But they're already expanding testing and development into wider, quite sophisticated markets like Germany and Japan.
Germany and Japan. Okay, major auto markets.
Right. Which suggests that this ML camera approach to autonomy is moving beyond just the proof of concept stage. They seem to be pushing towards real-world scaling, even if it's still early days overall.
Okay. So we see this incredible velocity of private capital, $500 million, flying into one specific future tech. Almost seems immune to the broader economic jitters we'll get to later.
Yeah, it feels like a separate world sometimes.
But as you said, that speed doesn't exist in a vacuum. All that innovation, all that money being deployed, it immediately runs smack into the friction of global politics.
Always does.
Which brings us neatly to our second segment, the geopolitics theater. Because that impending Trump-Xi call is grabbing just as many headlines, maybe more, than NVIDIA's big bet.
Exactly. We shift gears now. Trump and Xi are scheduled for this highly anticipated call on Friday morning. Reports say it's set for 9 a.m. Eastern time.
And this is significant because it's the first time they've spoken directly since June, right?
That's what's reported, yeah. First direct conversation in several months between the leaders of the world's two biggest economies. And importantly, it follows some recent groundwork. Their key aides, like Treasury Secretary Scott Bessent and Chinese Vice Premier He Lifeng, met earlier this week in Spain.
Preparatory meetings suggests they're not just picking up the phone cold. They're trying to perhaps manage expectations or set an agenda.
Presumably, trying to achieve something, even if it's just stabilization, because the issues on the table are deeply complex. You've got national security concerns, huge trade imbalances, and this ongoing battle over technological control.
And the two big flashpoints seem to be the tariffs, the sort of ongoing economic pressure tool, and the never-ending TikTok saga.
Which is really about more than just a social media app, isn't it? It's become a symbol of algorithmic control and data sovereignty concerns.
Let's tackle TikTok first, then. Trump sounded pretty confident recently. He claimed a deal is all but completed.
You did use that phrase, yeah.
And he promised the final company structure would be controlled by all American investors, which, sounds very decisive, very clear, especially to a U.S. audience.
It does. But, and this is crucial, the Chinese perspective, which we saw articulated through their state media outlets, was, well, let's say carefully worded.
How so?
They acknowledged a framework deal was discussed, yes, but they emphasized what they called the consensus reached for the continued operation of Chinese enterprises, including TikTok, in the United States. Notice the slightly different emphasis there.
Yeah. Continued operation of Chinese enterprises. It's subtle, but it sounds like they're focusing on ensuring Chinese companies can still operate, whereas Trump is focused on U.S. control of the specific TikTok entity.
Exactly. It's a diplomatic tightrope walk. And the critical tension, the core unresolved issue that seems to be lurking beneath the surface, isn't really about who owns the shares in the new U.S.-based company shell.
It's the algorithm.
It's almost certainly the use and, more importantly, the control of the Chinese-controlled algorithm that powers TikTok. That algorithm, that's the secret sauce, right? That's what makes the platform so addictive, so engaging, and ultimately a multi-billion-dollar success.
So even if a U.S. consortium, like the one reportedly involving Oracle, technically owns the U.S. entity.
Right. Oracle, Andreessen Horowitz, Silver Lake Management, those are the names being floated.
Even if they own it, if the core recommendation engine, the AI deciding what videos you see, is still dictated or heavily influenced by the Chinese parent company, ByteDance.
Then the original national security concerns about potential data access or manipulation haven't really gone away.
And Trump himself sort of acknowledged the value, didn't he? Said the platform has tremendous value and he wants to reap the benefits rather than just ban it.
Right, which makes this negotiation incredibly tricky. For traders, for anyone watching the market reaction here, this means keeping a very close eye on the companies reportedly involved in that U.S. consortium, especially Oracle or RCL.
So any headline, any rumor about the TikTok deal structure, especially concerning the algorithm, that's going to cause big swings in Oracle stock.
Almost certainly.
Yeah.
Huge potential for volatility there. And maybe in broader U.S.-China ETFs too, depending on the overall tone of the call.
Okay, let's switch to the tariff tightrope then, because these have massive real-world implications for global trade flows, supply chains, and maybe most directly for consumers, inflation. Where do things stand right now?
Well, the current duties are still pretty steep. It's generally 30% on a wide range of Chinese imports coming into the U.S. and 10% on many U.S. goods going into China.
And that's just the baseline, right? There are other sector-specific tariffs on top.
Exactly. Things like steel, aluminum, certain machinery, they might have additional duties. So the effective tariff rate, the actual burden on specific goods, can often be even higher than those headline numbers.
And Trump recently hinted about an extension?
Yeah, he hinted that he might be seeking a partial extension based on the current terms. This feels like a classic political maneuver, kicking the can down the road a bit.
Avoiding a bigger fight right now.
Potentially. It would mean pushing off the potential return to those really aggressive triple-digit tariffs that were threatened earlier. Those face a November deadline under the current framework. So getting a partial extension, just continuing the status quo for a while longer.
Would probably be seen by the markets as a temporary relief, right?
Yeah.
A bit of near-term stability for import costs.
I think that's likely how it would be perceived, yes. A sigh of relief, maybe, even if the underlying issues aren't resolved.
But the economic reality of these current tariffs, the 30% and 10%, is already pretty significant. And the administration seems keen to highlight the revenue they're bringing in.
Oh, absolutely. Treasury Secretary Bessent has been quite vocal about it. The duties reportedly brought in a record high, nearly $29.5 billion just in August.
Wow, almost $30 billion in 1 month.
Yeah. And Bessent has publicly framed that as helping to, quote, fix the financial shambles, using tariff revenue to offset other budget pressures.
Okay, but there's another side to that coin, isn't there? Who's actually paying that $30 billion?
Well, that's the debate. Economists like Joe Brasulas over at RSM consistently argue that these tariffs largely function as a tax paid either by U.S. importers who have to absorb the cost or, more often, passed on to domestic consumers through higher prices.
So it fuels inflation?
It certainly puts upward pressure on prices, yeah. You see it most clearly, perhaps, in consumer goods like food and apparel, things directly imported. But it also affects intermediate goods like machinery and auto parts, where U.S. manufacturers rely on components from China. That increases their costs, which eventually feeds through to final prices, too.
So, okay, the tariffs generate immediate cash for the government, which they like,
Right.
but they also act as this kind of hidden cost, pushing up prices for everyone else at a time when inflation is already, a major concern.
That's the fundamental tension, yes. Trying to balance the perceived benefits of the revenue and trade pressure against a very real inflationary impact.
But hang on, you mentioned something earlier. There is a legal cloud hanging over these tariffs.
Ah, yes. This is a really critical detail, something that anyone following this closely needs to understand. The entire tariff regime, or at least a very significant chunk of it, is currently resting on somewhat shaky legal ground.
Shaky how?
Well, a key swath of Trump's reciprocal tariffs, the ones imposed broadly rather than on specific national security threats like steel, were implemented under a law called the 1977 International Emergency Economic Powers Act, usually shortened to IEPA.
IEPA, International Emergency Economic Powers Act. Okay, that sounds like something you'd use for, well, emergencies, sanctioning rogue states or something, not for setting long-term trade policy.
Precisely. That's the core of the legal challenge. IEPA grants the president pretty broad authority to regulate international commerce after declaring a national emergency related to an unusual and extraordinary threat originating outside the U.S. The argument being made in court is that using IEPA to impose these long-term, widespread tariffs on a major trading partner, simply based on general trade imbalances or economic competition, goes beyond the specific emergency-focused authority Congress intended to grant back in 1977.
So the argument is basically he used the wrong tool or stretched the definition of emergency too far.
Essentially, yes.
Yeah.
That it exceeds the statutory authority granted by that specific law. And this isn't just a theoretical debate.
It's actually in the courts now.
Yes.
Yes.
It's being actively challenged in 2 federal courts right now, and everyone is anticipating a final ruling from the Supreme Court, possibly before the end of this year.
Wow. Okay, so what happens if the challengers win, if the Supreme Court rules against the administration?
This is where it gets potentially explosive for the administration's finances. Treasury Secretary Bessent himself has estimated publicly that a negative ruling, if the Supreme Court decides the administration did indeed overstep its IEPA authority, it could force the Trump administration to give back roughly half of all the tariff revenues collected under that specific IEEPA authority.
Half. Wait, half of the nearly $30 billion a month you mentioned earlier. We're talking tens, maybe hundreds of billions of dollars suddenly needing to be repaid.
Potentially, yes. Depending on how far back the ruling applies, it would be an absolutely massive financial earthquake for the U.S. Treasury's budget projections. It would instantly drain billions, maybe tens of billions, from government coffers.
And that would dramatically amplify the urgency of the whole debt problem we're about to discuss, wouldn't it?
Hugely. It creates this profound layer of uncertainty hanging over U.S. fiscal policy right now, a massive contingent liability.
So regardless of whether we see some kind of temporary truce or an extension agreed upon in this Trumpshy call,
Right.
the bigger picture suggests this isn't really about getting back to normal, is it? It sounds more like managing the pace of decoupling.
I think that's a very accurate way to put it. Managing the speed of economic separation, most serious analysis suggests the larger structural trend is still towards the global economy gradually coalescing into 2 distinct spheres of influence. 2 blocks.
One orbiting the U.S. and its allies, the other centered on China and its partners.
Exactly. And that separation, slow or fast, impacts everything from who builds your 5G networks to where manufacturers source their components to global commodity flows. It's a fundamental realignment.
And that structural realignment, that uncertainty, forms the perfect, maybe unsettling backdrop for our final segment. The big macro warning, particularly from Ray Dalio.
Yes. We've seen the incredible speed of tech capital with Nvidia. We've seen the friction and complexity of geopolitics with the U.S.-China talks. Now we need to look at the potentially shaky foundation underneath it all.
The debt.
The debt. Ray Dalio's core argument, which he laid out pretty forcefully at the Future China Global Forum 2025 recently, is stark. He says U.S. debt levels are now, quote, unsustainable.
Unsustainable. That's a strong word from someone like Dalio.
Very strong. And he argues the country is accelerating towards a major fiscal crisis, one that will inevitably put the entire current monetary order at risk.
And it wasn't just him saying this, right? The sources mentioned others on that panel echoed the concern.
That's right. Engkok Song, who's the founding partner and chairman of Avanda Investment Management, was on the same panel and reportedly noted that this unsustainability has reached the tipping point. He added, "We do not know when the crisis is going to unfold. which adds that element of immediate uncertainty.
So it's not just one prominent voice, it's a growing chorus warning about systemic risk. And it's not just a U.S. problem either.
No, absolutely not. While Dalio focused heavily on the U.S. due to its scale and the dollar's global role, the sources make it clear that similar fiscal risks, government spending far more than they take in, are mirrored in other major economies like France, Japan, and even China itself, although their situation's a bit different. It's a global phenomenon of excessive borrowing.
Okay, let's dig into the numbers then. The fiscal math that's driving this panic. Because unsustainable is one thing, but what does it actually look like?
The numbers are, frankly, pretty staggering. Dalio highlights the sheer scale first. The total U.S. government debt is now roughly 6 times the amount of annual revenue the government takes in.
6 times annual revenue tied up in debt. Just wow. If a company had a balance sheet like that, the alarms would be screaming, wouldn't they?
Absolutely. Immediate distress signals. And the problem, Dalio argues, is massively amplified by a growing supply-demand imbalance in the government bond market, the market for U.S. Treasury.
Supply-demand imbalance, meaning too much debt being issued.
Way too much. Dalio estimates that just to keep the lights on and manage existing obligations over the short term, the U.S. government needs to sell an almost astronomical $12 trillion worth of new debt.
12 trillion with a T. Where on earth does that number come from? That sounds almost unbelievable.
It does, but let's break it down. It's composed of 3 main unavoidable and immediate funding needs. First, you have the ongoing annual budget deficit, the gap between spending and revenue, which is running at about $2 trillion a year right now.
Okay, 2 trillion for the deficit.
Second, you have the interest payments on the existing mountain of debt. With interest rates having gone up, that's now costing roughly $1 trillion per year.
1 trillion just to service the existing debt. Okay.
And third, and this is the really big chunk, you have about $9 trillion worth of existing government bonds that are maturing, coming due in the near term, that need to be rolled over, meaning the government have to borrow new money to pay back the old money.
So $2 trillion deficit plus $1 trillion interest plus $9 trillion rollover equals 12 trillion.
That's the math. $12 trillion worth of U.S. treasuries that the government needs the market to buy relatively soon. And Dalio's core point is, the market simply does not have the natural appetite, the demand, to absorb that colossal volume of new debt issuance.
So the government needs to sell $12 trillion worth of bonds, but who's supposed to buy them all? Why does Dalio think the demand isn't there anymore?
Well, a few key reasons. Historically, foreign buyers, especially central banks in countries like China and Japan, were huge purchasers of U.S. debt. But lately, they've become much more hesitant.
Why? Geopolitics.
Partly geopolitics, partly seeking diversification, partly concerns about the U.S. fiscal trajectory itself. Many are preferring to allocate more capital toward other assets like gold, which we'll get to, or investing domestically instead of parking trillions in U.S. treasuries.
Okay, so foreign demand is down. What about domestic buyers?
Domestic savings rates in the U.S. just aren't high enough to absorb that sheer volume either. Pension funds, insurance companies, individual investors, they buy treasuries, of course, but likely not on the scale needed to soak up an extra $12 trillion without significant disruption.
And if the demand isn't there naturally, what happens? The government has to offer higher interest rates to attract buyers.
Exactly. This demand deficit forces the Treasury to increase the yields, the interest rates it offers on new bonds to make them more attractive. But, of course, paying higher interest rates
Just increases the cost of borrowing even further, making that $1 trillion interest payment even bigger in the future.
Precisely. It risks becoming a negative feedback loop, a vicious circle. More debt requires higher rates, which creates more debt.
And the political situation doesn't seem to offer much hope for breaking that cycle, does it?
Not really, no. Dalio mentioned he actually proposed a path to reduce the fiscal deficit, getting it down to a more manageable, say, 3% of GDP when talking to lawmakers in Washington.
And how did that go down?
According to him, politicians on both sides of the aisle were basically reluctant. Nobody wants to make the painful spending cuts or significant tax increases required to actually balance the books, especially not in an election cycle.
Yeah, cutting popular programs or raising taxes is rarely a vote winner.
And what's more, major upcoming policy initiatives, particularly the massive tax and spending bill currently being championed by Trump, are projected by independent analysts to add another $3.4 trillion to the national debt over the next 10 years.
So instead of tackling the problem, policy is actually set to make it significantly worse.
That appears to be the trajectory, yes.
Yeah.
There seems to be very little genuine political will from either party to actually solve the underlying math problem.
Okay, so If governments around the world, but especially the US, are unwilling or unable to stop this excessive spending and borrowing, the debt just keeps growing relative to the economy. What's the inevitable end game there, according to Dalio? What does it mean for our money, for the dollar?
The logical consequence, Dalio argues, is an increasing risk of currency devaluation across the board, not just the dollar, though its global role makes it particularly significant.
How does that work? More debt leads to weaker currency.
Think about it. If the supply of government debt becomes almost infinite because they keep issuing more and more, but the natural market demand is finite, eventually, the only buyer left with deep enough pockets is the central bank itself, the Federal Reserve in the U.S. case.
So the Fed steps in and buys the government bonds that nobody else wants.
Effectively, yes. Through processes often called quantitative easing or QE, but when the central bank buys government debt, it essentially does so by creating new money out of thin air, printing money in simple terms.
And printing money devalues the money already in circulation. Basic supply and demand.
Exactly. Too much supply of currency chasing the same amount of goods and services leads to inflation and erodes the purchasing power of that currency. That's why Dalio's analysis immediately pivots from the debt problem to a store of value solution.
Right. Hedging your bets, protecting your wealth from being inflated away.
Precisely. His specific recommendation is for investors to seriously consider diversifying their assets, and he explicitly urged holding around 10% of a portfolio in gold.
10% in gold. Why gold specifically?
His reasoning is pretty straightforward. As governments globally seem intent on inflating their way out of their debt burdens because actually defaulting is politically unthinkable, and austerity is politically unpopular, all fiat currencies backed only by government promise, risk losing their appeal as reliable repositories of wealth over the long term.
Because governments can just print more of them, but they can't just print more gold.
That's the historical argument. Gold is finite, tangible, and outside the direct control of any single government or central bank's printing press. It's seen as a hedge against monetary debasement.
And it seems like big players, central banks themselves, are already reflecting this shift in thinking.
Yes, the data supports that. Our sources confirm that global central bank buying of gold has been very strong in recent years. Gold has effectively become the second largest reserve asset held by central banks globally after the U.S. dollar itself.
Second largest. That's a significant status.
It really is. It illustrates a fundamental shift in how global central banks and major sovereign wealth funds are thinking about long-term stability and diversifying away from holding solely fiat currencies, particularly the dollar. It reinforces this idea that non-fiat stores of wealth, like gold, might become increasingly important.
But Dalio isn't predicting the complete collapse of the dollar, is he? It still plays a huge role.
No, and that's an important nuance. He does temper the warning slightly. While he sees risks to the dollar's store of value function, he still believes the U.S. dollar will likely retain its dominance as the world's primary medium of exchange.
Meaning people will still use it for trade, for transactions.
Yes, for pricing oil, for international contracts, for everyday global commerce. The dollar's infrastructure and network effects are just too entrenched to disappear overnight. The issue isn't whether you can spend dollars. It's whether the dollars you hold will retain their purchasing power against that backdrop of, $12 trillion in looming debt issuance.
Store of value versus medium of exchange. That's a key distinction.
It is. And even though the Chinese currency, the yuan, is making some inroads in specific bilateral trade deals, it's nowhere near challenging the dollar's global dominance as the main currency for transactions. But as a store of wealth, that's where gold and potentially other non-fiat alternatives gain appeal.
It's interesting. This focus on gold, this nervousness about debt, it even connects back slightly unexpectedly to the tariff discussion we had earlier. There was a specific detail about gold in one of those recent executive orders, wasn't there?
Yes, there was. A small but very telling detail. When the administration recently issued an executive order related to the reciprocal tariff regime, there was a notable carve-out, an exemption. That order specifically excluded bullion-related articles from being subject to the new tariffs.
Bullion-related articles, so physical gold bars, basically.
Essentially, yes. And this exclusion came after some earlier market chatter and fear that physical gold imports might get caught up in the tariff net, which had apparently caused some brief but significant turmoil in the gold markets.
So the government specifically made sure not to put tariffs on gold, even while putting them on lots of other things.
Exactly. That little exclusion suggests the administration is actually quite sensitive to market reactions concerning physical gold. Why potentially create an uproar in the ultimate safe haven market if you're already dealing with a massive debt overhang and a tariff structure facing serious legal challenges?
Right. Don't spook the gold market when confidence and everything else feels a bit fragile.
It certainly looks that way. It suggests that even amidst the sometimes chaotic application of trade policy, they recognize gold's unique status right now as a crucial stabilizer, a sort of financial anchor, especially in times of rising fiscal stress and currency concerns. They seem aware that confidence in the dollar isn't guaranteed given the sheer scale of the debt.
Okay. So let's try and tie these three threads together for you, the listener. We've covered a lot of ground, from high-speed tech investment to global political friction to these deep, slow-moving macro financial cracks.
It's a complex picture. So first, in AI mobility, we saw Nvidia making a very strategic, very large bet, $500 million into Wayve. This isn't just about chips, it's about dominating future AI ecosystems. Their bet is on Wayve's specific, potentially more scalable machine learning and camera approach to self-driving. That's a key tech trend to watch.
Okay, second, geopolitical trade. The upcoming Trump-Xi call, the ongoing saga around TikTok's algorithm, and the tariff situation, all of this is driving immediate market volatility. Keep an eye on Oracle for TikTok news.
Right. And while we might see a temporary truce or maybe an extension on tariffs pushing the deadline past November, the bigger underlying trend seems to be a structural separation, a gradual decoupling into distinct U.S. and China economic blocs. Plus, remember that massive legal uncertainty hanging over the existing tariff revenue because of the IEEPA challenge.
Got it. And finally, the macro hedge. Ray Dalio's stark warning about unsustainable global debt, particularly the U.S. needing to somehow find buyers for $12 trillion in bonds, strongly suggests the need for hedging strategies.
Yeah, the core risk there is currency devaluation, driven by governments effectively printing money to cover their debts. This makes traditional safe havens, particularly gold, look increasingly attractive as a primary defense, a way to potentially preserve wealth if fiat currencies lose purchasing power. Dalio suggests around 10% allocation.
So pulling that together into today's kind of actionable playbook, thinking like a trader, maybe you look to NVDA for signals on growth momentum, especially around AI and autonomous tech news. Keep a close watch on ORCL and any TikTok headlines for potential short-term volatility plays. And consider gold, maybe via ETFs or miners, as that portfolio seatbelt, the safety hedge against the bigger systemic risks Dalio highlighted.
That seems like a reasonable summary of the signals. Yeah, this incredible innovation and growth happening. Look at Nvidia's confidence, that $500 million bet on the future of mobility. It's real. It's happening now.
Huge energy there.
But it's occurring against this deeply unsettling backdrop of systemic fiscal instability. Dalio's $12 trillion warning isn't hypothetical. It's based on current deficits and debt maturities. That instability is just as real.
So for you, the listener, perhaps the ultimate question to ponder going forward is, which of these powerful opposing forces will ultimately define the market landscape over the next decade? Will it be the exponential growth driven by technological innovation and that velocity of private capital? Or will it be the exponential growth of sovereign debt, potentially undermining public finances and currency stability?
That fundamental tension tech optimism versus fiscal reality. That's likely what will drive the biggest market narratives, the biggest opportunities, and the biggest risks for years to come.
Definitely something worth keeping a close eye on. Do your own research, of course.